Target date funds. Are they the perfect choice for investors or just another set it and forget it trap? Let's break down the pros and cons of target date funds so you can decide if they actually work for you. Now, a target date fund is an all-in-one investment that automatically shifts from stocks to bonds as you get closer to retirement. You might start out with mostly stocks and very little bonds, and then as you get closer to retirement, that allocation automatically shifts so that you end up with more and more bonds and less stocks along the way. And usually they're tied to different dates based on the date that you plan to retire. So for example, you might be invested in a 2065 target date fund, which assumes that you're going to retire in 40 years, and the fund has an allocation that gets more and more conservative as you get closer to that target retirement date. And a fund with a really far out date like that is probably what you want if you're just starting out investing and you want that pedal to the metal growth, because it's going to have hardly any bonds. It's going to be mostly stocks and it's going to be a lot of growth. Contrast this with another example, maybe a 2030 fund that might be shifting at this point closer to 60% stocks, 40% bonds, with retirement only 5 years away. So you pick the fund that's closest to your retirement year, and it gradually shifts from aggressive, more stocks, to conservative, more bonds over time. Here are some key stats about target date funds. As of recent reports, over 75% of 401k plans offer target date funds as an option. And around 60 to 70% of new contributions in workplace retirement plans go into target date funds. Target date funds have gained popularity because they offer automatic diversification and risk adjustment over time. All right, so what are some pros of target date funds? Well, they are simple and easy to use. That is absolutely one of the great features of it. You just pick the year that's closest to your retirement date and the fund does the rest. It's a set it and forget it kind of thing. No need to rebalance or tweak your portfolio constantly. You can pick your date, set up your automatic investment, and not even look at it for 40 years if you don't want to. Target date funds are great for people who want a hands-off approach to investing. Another pro is the diversification in one fund. That's right, target date funds typically include a mix of US stocks, international stocks, bonds, and sometimes alternative assets as well. So you're automatically diversified by just buying this one fund. This helps reduce risk and volatility compared to putting all your money in just one asset class, like all in US stocks, for example. And you only have to make the one decision. You don't have to figure out what's the best fund to invest for US stocks, what's the best fund for international, what's the best fund for bonds. Should I also have international bonds? Target date funds make those decisions for you. It's all kind of curated. You buy the fund, you pick the date, and that's it. Another pro of target date funds, they automatically adjust risk over time. Early on, the fund is going to be more aggressive with more stocks, aiming for growth. And this is probably what you want for most of your working career, where you're in that accumulation phase and you're trying to grow your portfolio as much as possible. You're not concerned as much with volatility because every month or every pay period, you're putting in more and more money into the account. But as you near retirement, the fund gradually shifts toward bonds for more stability, less volatility. The idea is that you don't have to manage this transition yourself, and you don't have to pay an investment advisor. The fund does it all for you. Another pro of target date funds, they are a good default option for 401k plans and other similar workplace retirement plans. Yes, many employer-sponsored retirement plans default to target date funds, which is better than employees sitting in cash, not investing at all. Now, if you're not sure where to start, target date funds are always a decent choice, and they can be better than actively managed, higher fee choices. Most target date funds you're going to find are based on index funds. So if you look underneath the covers, it's going to have components that are index funds. You might have a stock index fund, an international index fund, bond index fund. These different funds are going to comprise the target date fund. And because these are index funds, they're going to have lower fees overall. I'm sure there are actively managed target date funds out there somewhere, but I've never come across one. All right, now that we've described why target date funds are freaking amazing, we have to turn to the other side. We have to talk about the cons of target date funds. The first con of target date funds is that it's a one-size-fits-all approach. Target date funds assume that everyone retiring in the same year has the same risk tolerance, financial situation, and goals, which just isn't true. If you're more risk averse or you have other investments in addition to the target date fund, the standard allocation that is in the target date fund might not be ideal for you. Another con, the glide path might not fit your needs. The way a target date fund shifts from stocks to bonds, known as the glide path, well, it might be too conservative or too aggressive for you. Either way, it's out of your control. The fund is set up to do what it's going to do, and some funds shift too quickly, locking in lower returns, while others stay too aggressive for too long, which could expose you too much to market drops. And sometimes it's not even clear in these funds exactly what the asset allocation is. The target date funds that I have access to don't seem to be accurate as far as the current allocation. You can look in 3 different places on the website and see 3 different asset allocations for the current state of the fund, and it's like, what's the real current asset allocation? And if you do have a target date fund in a workplace retirement account, but then you also have other retirement accounts, it can be hard to track your overall asset allocation across these various accounts. Another con is that there can be higher fees than do-it-yourself investing. Target date funds are often just a little more expensive than if you bought the funds that they contain individually. You could simply buy a mix of low-cost index funds and rebalance those funds yourself, and you're likely to pay less of an expense ratio than you would by buying the target date fund. Another con of target date funds, they underperform. This article on Morningstar is an interesting read. It explains why target date funds have underperformed even balanced funds with similar stock-bond splits. Balanced funds have a set percentage of stocks and bonds within them, but unlike target date funds, that percentage stays fixed over time. And balanced funds have done better than target date funds. The reason, it turns out, is not based on target date funds having less stocks than balanced funds or the timing of the glide path in the target date funds. No, the reason that balanced funds have outperformed is that they have less international stock exposure. International stocks have lagged US stocks over the past 15 plus years, and target date funds, at least from the largest providers like Vanguard and Fidelity, have more than 30% of their stock exposure in international stocks. That fact alone explains why target date funds have underperformed balanced funds. So, are target date funds good? If you want a simple, hands-off way to invest and don't want to worry about rebalancing and don't mind the sizable exposure to international stocks, then yes, they can be a solid option. And you don't have to use them exactly as intended. If you're planning to retire in 2050, you don't have to use the 2050 target date fund. You can pick whatever date you want. If you want to be more aggressive, pick a date that's later. If you want to be more conservative, pick an earlier date. And it's important to consider the target date fund that you pick along with all your other investments, some of which may be in other accounts, maybe a Roth IRA or a taxable account. And when you're thinking of your asset allocation, you want to consider all of your accounts, all of your investments across all of your accounts, not just your target date fund. Sometimes in a 401k or similar workplace retirement plan, a target date fund is absolutely going to be the best option available. And they absolutely make it easy to do the right thing as an investor. You really can't mess up if you pick a target date fund that makes sense for you and stick with it. And at the end of the day, a target date fund makes a lot of sense as long as it gets you to your goals. Not everyone wants to complicate investing or think about it too much. They just want a set it and forget it approach while they focus on earning more money and saving more money, because that is what's going to move the needle much more than optimizing the perfect investing approach. But if you prefer more control and want to optimize for fees, or you have specific investing goals that a target date fund just can't meet, well, then you might be better off building your own portfolio. I prefer to build my own portfolio because I'm a giant investing nerd. Now, if you found this video helpful, hit that like button and subscribe for more videos on saving, investing, and early retirement. And if you want to know the real reason why a 401k is one of the best ways to build wealth, you can check out this video right here. Thanks for watching.